Sage for 5 years. I qualified as a chartered accountant in practice, and my role at the moment is I work with a team of accountants, software developers and testers, and we look at what we need to put in the software to keep it compliant. So obviously the last year and certainly the next year is really busy time for us, with so many changes happening. So I was basically just going to give a bit of an overview of why everything's changed, what the new standards are, and then what your accounts are going to look like under FRS 102, what some of the key differences are, and what you need to do in that first year when you're transitioning over to the new accounting framework. And then also was going to look at just quite high level at the changes in UK company law that have just gone through for small companies, and what's happening with the frizzy and the impact on the accounts for that. And then just finish off with some practical considerations to be thinking about. So why have accounting standards changed? So at previous accounting standards were quite inconsistent. It was quite sort of a random mix of financial reporting standards, IFRS-based standards. So the idea was really to bring it all in line and have a single and consistent accounting framework that's in line with IFRS. And the idea of that being that certainly for groups where the parent reports under IFRS, the subsidiaries under UK GAAP, it's a lot more aligned. It's easier to compare financial information and to interpret financial information across different accounting frameworks. Who's affected by this is it's mainly large and medium-sized companies in the UK, or entities, I suppose. Entities that apply frizzy currently aren't affected, but they will be, which I'll come on to a bit later. So currently FRS 102 isn't applicable for frizzy, and if you apply EU adopted IFRS, you also aren't affected by FRS 102. It's mandatory for accounting periods beginning on or after the 1st of January 2015. So in terms of the key dates, it's accounting periods beginning then, so typically it's going to be your December 2015 year ends that are affected. You can early adopt from December 2012. And another key date in this is your transition date. So the transition date is the first day of the earliest accounting period presented in the accounts. So if it's a December 2015 year end, your transition date is actually the 1st of January 2014. So it almost covers, sort of a 2-year period there. So these are the standards in issue. So FRS 100 is more just outlines the framework. So it just outlines which standards you should apply, when you should transition, who the standards are applicable for, and if a SORP is relevant, so if you're an LLP or a charity, it also outlines how you incorporate the SORPs in with FRS 102. FRS 101 is disclosure exemptions for entities that apply IFRS or that are planning to apply IFRS. So if you currently apply UK GAAP and you're going to continue applying UK GAAP, then the disclosure exemptions in FRS 101 aren't for you, but there are some disclosure exemptions within FRS 102. So FRS 102 was broadly based on IFRS for SMEs. They had to make some changes to account for UK company law, and then they allowed a few additional accounting policy choices. And like I said, it does include some reduced disclosures, and I'll mention those a bit later on. And then there's FRS 103, which is around insurance contracts. So primarily, this will be for insurance companies, but it affects anyone who issues insurance contracts or reinsurance contracts. So some product warranties may meet the definition of an insurance contract. So that's something to be aware of, that might fall within the measurement and recognition criteria of FRS 103. So moving on to your financial statement. So I think one of the key differences in FRS 102 is the terminology. So it's very IFRS based. They refer to statement of financial position rather than the balance sheet and things like that. The Companies Act formats that at the moment govern the presentation of what's at the moment the balance sheet and the profit and loss account, they continue to apply. So there aren't many differences presentationally there. You now have a statement of comprehensive income, which replaces the statement of total recognised gains and losses. So that's just showing your total income, not just your recognised income. You've got a statement of changes in equity, which we didn't have under UK GAAP. So that just reconciles each component of equity. And a statement of cash flows, which is more or less the same as the IFRS one. So that's reported under 3 categories rather than the 8 or 9 that we currently do. So that's quite significantly different in terms of the presentation of it. There are options around which statements you can present. So you can, depending on the transactions you have, you can choose to combine your income statement with your statement of comprehensive income, or your statement of changes in equity with your statement of comprehensive income. Some of those changes constitute as a change in accounting policy, so it's not a case that you can sort of choose each year which one you want, how you want to present it. But that's certainly something that's worth looking at in advance and choosing which is the best approach for each client. And then the notes to the accounts, again, just on the, what just to look at them, how they look different is obviously your accounting policies are going to be different under FRS 102, so those need reviewing and updating. There's a note required to make a statement of compliance. So FRS 102 requires you to explicitly state that you're following that standard. And also in the first year of adoption of FRS 102, you're going to need a transition note. So as well as stating what your changes in accounting policies are, you also need to provide a reconciliation of how financial position and financial performance has changed from your old accounting standards to your new accounting standards, which means basically providing a reconciliation of your comparative period end and the first day of your comparative year under what was the old GAAP and what's under the new GAAP. So that's something to be aware of just for the first year of those accounts. So these are some of the key differences. It's not an exhaustive list. There's quite a lot that's changed, and obviously how much it affects each client depends on the transactions, but these are just some of the sort of key things that I've pulled out. So financial instruments is quite a big area of accounting anyway. At the moment, I don't think a lot of people follow the UK accounting standards on financial instruments because they're not mandatory apart from for larger companies. But FRS 102 does sort of split those out into basic financial instruments and other financial instruments. So basic are things with quite straightforward terms, so trade debtors, trade creditors, and other financial instruments are more complex things, so like derivatives, things like that. There are disclosure requirements now for financial instruments, so even if you've just got trade debtors and trade creditors, you are required to make a disclosure in the accounts about those. Derivatives are now recognised on the balance sheet or the statement of financial position. So previously, those would have gone unrecognised. But if you have anything like, like foreign currency exchange contracts, forward contracts, anything like that, they're going to need to go on the balance sheet. So for more complex financial instruments, there's probably a bit more work to do to make sure those are accounted for correctly. Defined benefit pension plans probably aren't that common anymore, but if you do have them, they're quite a complex area, certainly in terms of meeting the disclosure requirements. There aren't significant changes under FRS 102 in terms of the disclosures. There are some changes in the accounting treatment. So at the moment, you'd have your current service cost, you'd have an interest cost on plan liabilities, and you'd have the return on plan assets. And those would go through your profit and loss account, and any actuarial gains and losses through your struggle. Under FRS 102, rather than recognising your interest on the liabilities in the finance cost note and your return on plan assets separately, you effectively have a net interest cost. So you work out the net position of the defined benefit plan, surplus or deficit, and then apply an interest rate to that. So because of that, you're applying, effectively, you've got, rather than a return on plan assets, you've got interest income, and that's probably going to be at a lower rate, so there could be impact to your profit and loss account there. Another big area, a significant change, is on investment properties. So for anyone who has investment properties, any revaluation gains and losses at the moment don't hit your profit and loss account. They go straight to reserves via the statement of total recognised gains and losses. Under FRS 102, they go through your profit and loss account. So gains and losses will hit your sort of the bottom line there. Business combinations. At the moment, in a business combinations, most intangible assets just get included within a goodwill figure. But now the sort of the requirements for when you identify them and how you separately identify them, the criteria have changed. So more intangibles will need to be recognised separately. You can't really lump them all together and say, oh, well, it's goodwill. So again, on any business combinations, there'll be a bit more work involved to identify them and value them. There's a change in the useful life of goodwill. So previously, if you couldn't reliably estimate it, it was presumed to be 20 years, and that's now 5 years. So again, an impact potentially on your profit and loss account on how you're amortising or impairing goodwill. And then merger accounting, I don't think is very common at the moment, but even more so under FRS 102, it's very strict as to when you can use merger accounting. And finally on to deferred tax. So that's now taken a timing difference plus approach. So the criteria of what you can recognise deferred tax on has changed. So likely to be more liabilities recognised. So, for example, revaluation of tangible assets, you wouldn't have recognised deferred tax previously, but you can under FRS 102. So, like I say, very high level and not at all an exhaustive list, but just gives you an idea of some of the key areas to watch out for, really. So, first time adoption of FRS 102 is going to be quite a big thing, I think. You know, that first set of accounts, getting used to what needs to go in there and understanding how to transition and what you need to disclose. I think it's section 35 of FRS 102 goes through in detail all the transitional arrangements. But one of the main things is preparing your transition balance sheet. So generally you need to apply any changes to accounting policies and things retrospectively. You need to restate your comparative figures and effectively your pre-comparative figures in order to get that value at your transition date. There are exceptions where you can't retrospectively, where it says don't retrospectively apply those changes. So things like accounting estimates, you wouldn't usually go back and restate based on accounting estimate changes. And there are areas where you can be exempt from restating comparative data. So that's something else I think that's important to understand what those areas are and is it beneficial or not to apply them. It's not a you either do all or nothing. You can choose which ones you do. So for example, business combinations, you don't have to restate all your business combinations prior to the transition date. But if you choose to restate any, you have to restate any subsequent business combinations after the one that you've restated. And dormant companies, again, you can elect not to restate your accounting policies for dormant companies up until the point that there is a change in a balance or there's a transaction. So again, if there are any changes for dormant, if those can be done prior to the transition date, it's going to save sort of restating your accounting policies for those. And timescales are going to be really important. Like I said, it's mandatory from the 1st of January. So the transition date is the 1st of January 2014. And you're going to need to get, if you need to retrospectively apply that, you're going to have to get values from January 2014. So preparing in advance obviously is more helpful, or making sure you've got that information, because it could be quite difficult to go back and certainly get fair values of something that happened, sort of nearly 18 months ago. So preparation, I think, is definitely key on that one. Now, there are reduced disclosures available within FRS 102 for qualifying subsidiaries and ultimate parent companies. And I've pulled out all the areas affected, but the main ones really are around cash flow and financial instruments. The other ones are relatively minor, really. So under FRS 1, currently, if you're a small company, you don't need to include a cash flow. Under FRS 102, you have to include a cash flow, irrespective of size, unless you qualify for this exemption. So that's something that, again, could be quite a big difference in your accounts. If you don't qualify, you will need to include a cash flow statement. And again, I mentioned about financial instruments, that you need to make disclosures in your accounts for financial instruments. But again, there's an exemption available from disclosing that information for the parent. You're not exempting, the group isn't exempt, but the parent company would be. And then the other share-based payments, related party, share capital, are relatively minor. But again, you can choose which exemptions you want to take. So again, it's not all or nothing. You can choose those exemptions. But if you do choose those exemptions, you have to notify the shareholders of the company in writing that you've taken reduced disclosures. And you also have to disclose in your accounts which reduced disclosures you've applied. So if you do take them, remember to put that in your accounting policies. And that was it really on FRS 102. So quite brief. But I wanted to cover small company changes, because I think a lot of people for small companies thought, well, I'm not really affected by FRS 102, so I don't need to worry about it. But actually, there are changes in the FRISI, so it is probably worth covering. So small companies at the moment, as you all know, are governed by company law. So we've got the small companies regime and accounting standards, which is currently the FRISI. And both of those are changing at the moment. So on the small companies regime, I think in 2013 the EU issued a directive with amendments for small companies, and that EU directive sort of trickles down into UK company law. So the Department for Business Innovation and Skills issued a consultation on how this EU directive was going to be sort of brought into company law and got some responses on that, and I think that was passed through as a statutory instrument last month. So the EU directive said these are the options that you have. You have to make these disclosures, and then sort of gave some leeway on some items. So in terms of the size thresholds, the UK have taken the maximum available. So I've put a table there of what the size thresholds are going to be. In brackets are the thresholds as they are now. So the small companies threshold, although the employees hasn't changed, in terms of the turnover and balance sheet, it's gone up quite significantly. So a lot more companies, I think it was said 11,000 more companies will fall into the small bracket as a result of these changes. At the moment, or prior to this, the audit thresholds were aligned with the small companies thresholds. So the next thing I think that's going to be looked at is probably the audit thresholds. But I think BIS, the Department for Business Innovation and Skills, have said they'll consult on that separately. So that's something else that likely will change. There's changes to filing requirements. So a lot of small companies at the moment prepare full accounts for their members and the shareholders, and abbreviated accounts for filing to Companies House. That concept has sort of gone. So there is now a concept of a simplified set of accounts or abridged accounts, but those you could send to the shareholders and to Companies House for filing. So there wouldn't be two completely different sets of accounts. The disclosure requirements are quite minimal. The company law doesn't require a lot of disclosures for small companies, but there are a couple of changes. So in your staff cost note, you'll now need to include the average number of employees, which previously a small company wouldn't have included. And also any off-balance sheet arrangements need to be disclosed now, even if you're small. There's minor amendments for micro-entities, so you don't need a director's report anymore. And in terms of what's next, so that's been, this is now a statutory instrument. It's not mandatory until accounting periods beginning the 1st of January 2016. So that's likely to be your December 2016 accounts, but you can early adopt it. I'll come back on to early adoption when I look at the accounting standards side. So because of the changes to company law, the Financial Reporting Council have now had to look at the accounting standards that go hand in hand with small companies to make sure that they keep a consistencies between the legal framework and the accounting framework. And that's resulted in some financial reporting exposure drafts, or FREDs. So we've got FRS 105, which is going to be accounting standards for micro-entities. So micro-entities currently would most likely follow FRISI, but they're going to have their own set of accounting standards. It's going to be based, so the recognition and measurement criteria will be consistent with FRS 102, but the disclosure requirements will be a lot smaller for micro-entities. FRED 59 is going to replace FRISI, so that's a new section within FRS 102. Again, the measurement and recognition criteria are the same as FRS 102, but the disclosure and presentation is much more aligned with the needs of a small company. And then FRED 60 is really just draft amendments for FRS 100 and FRS 101, just to make sure that they still line up with company law and still meet those requirements. So those are expected to be finalised in July. I know I went to a small companies conference. There was sort of a discussion panel at the ICAW, and I know there were a lot of concerns raised around how quickly these were going to come in. So once they're finalised, again, they're effective for accounting periods beginning on or after the 1st of January 2016. So when you consider that you're changing to a new accounting framework, all the disclosures that I mentioned around first-time adoption and disclosing that transition note would still be applicable. And in that case, the transition date for these accounts is the 1st of January 2015. So even though they've not been finalised, we've already missed the transition date. So although you can early adopt, that's something to consider as to if you early adopt, your transition date's even earlier. So there's not a lot of time to prepare for them. And then finally, I was just going to cover some practical considerations. So staff training is obviously going to be, sort of key in this. So understanding what sort of transactions to look out for, what the disclosure requirements are, about the transition note and how that needs to be disclosed. The FRC have issued some staff education notes. So if you go on the FRC's website, you can quite easily find those. And they're really useful in sort of going into a bit more detail. So certainly on areas like the cash flow and things like that, they sort of say, this is what you did need to disclose and this is now what you need to disclose. They sort of do a comparative and also provide some illustrative examples which are really useful on some of these areas. FRS 102 doesn't have those illustrative examples that the current standards have, where they have a bit more guidance at the back of the standards, so those could be useful. Your software systems obviously have to be up to date, so not only your accounting software, but any software that you use to check your accounts, so any disclosure checklists and things like that. There's going to be a cost of the transition. The first set of accounts is going to require quite a lot of extra disclosures. You've got to restate your comparatives and your pre-comparatives, and that's going to obviously take time. So considering whether the accountant takes the cost of that or whether that's pushed onto the client and charged for that. So I think the client management is going to be really important, not only in terms of identifying which clients are going to be affected and planning for those, so making sure you identify the sorts of transactions they have, the information that you need to restate the comparatives, but also in terms of managing the client's expectations, because when you give them the accounts under FRS 102, they're going to look very different, the terminology is going to be different, the profit is certainly going to be different. And I know when I was in practice, generally a lot of owner-managed businesses knew what their profit was, and then under the accounting standards, changes in accounting policies is going to affect that. So I think that's going to be important in managing their expectations as well. And also on financial planning. So I mentioned about investment properties, gains and losses going through the profit and loss account. Those aren't distributable. So when you're looking at your dividend policy and dividend planning, you can't pay dividends out of those profits. So you're going to have to make sure that when you're looking at dividends, you're not paying out of just what's in your profit and loss reserve. You're going to have to sort of work out what you can distribute. Anybody who has bank loans or overdrafts that need sort of that comply with banking covenants and submit accounts to the banks, annually or monthly, quarterly. Changes in the accounting policies that impact the profit, impact net assets, things like that, could affect the your ratios and how close you are to meeting or breaching covenants. So it might be worth making sure the banks are aware of what the impact's going to be, and again that the client's aware that there could be some changes there. And then finally on IXBRL, so I'm not sure how much everybody knows about IXBRL, but any accounts that you send to HMRC with your tax return are now in IXBRL format. So IXBRL is basically an electronic tagging that attaches a little electronic tag around each piece of information in the accounts, which can be read automatically. So the list of tags is relevant to what gets disclosed in the accounts. So that list of tags has also changed to be in line with FRS 102 and the disclosure requirements. We were lucky at Sage that we worked with the Financial Reporting Council on determining what that list of tags needs to be and checking that it works with the software and that any changes and the concepts still worked. But anything that you do submit to HMRC under FRS 102 will need to be under this new taxonomy, so a new set of tags. And also e-filing to Companies House. They don't currently accept accounts under FRS 102 through e-filing. I think they are looking at that, and I'm sure they'll have that sort of done this year. But at the moment, if you do e-file, that's something to consider, that you'll have to sort of PDF or paper file on that. So that was it really. So quite high level, but I'm sure there's a lot of people wanting to sort of head home now. We've got a website at sageexchange.com. All the presentation notes from the lectures over the last 2 days will be on there. We also have quite a lot of information on more detail on the practical considerations. We've recently put up sort of a balance checker, so sort of a balance sheet showing for each line items what the key differences are, what's going to affect each line item of the balance sheet. And we're putting articles on there all the time, so that's worth sort of keeping an eye on really. So in terms of questions, I was going to head back out onto the stand. So if anyone does have any questions, feel free to come over, and me and my colleague Diana should hopefully be able to answer any of them. So I hope that's been useful. Thank you very much.